bad news hitting the US stock market right now isn't just coming one by one. It's a chain reaction of macro bombs. Brent crude just smashed through the $100 mark intraday, and Trump is weaponizing tariffs again, slapping Section 301 investigations on 16 different economies all at once. And the 10-year Treasury yield just spiked to a massive 4.22%. This perfect storm of bearish macro catalysts has already nuked the Japanese and Korean markets today. And the US market is highly likely going to face a bloodbath. If you're holding US tech stocks right now, you need to watch this video to the very end. Let's break down last night's price action. Energy was the only sector that caught a real bid. And obviously, they are the direct beneficiaries of the oil squeeze. The sector closed up over 1.3% on the flip side. Looking at the losers, real estate got absolutely slaughtered, dumping 2.55% in a single session. And tech stocks are also staring down the barrel of a massive correction. Look, smart money doesn't doubt Nvidia's ability to sell chips, but when you can get a 4.22% risk-free yield on treasuries, holding Nvidia at its multiples suddenly loses its appeal. Institutions were likely to choose to de-risk and dump. Cloud giants like Microsoft and Amazon, they are direct casualties of this oil spike because their core assets are data centers. When oil pumps, electricity costs pump right along with it. And data centers are absolute power guzzling monsters. Power accounts for 30% to 60% of their total OPEX. If utility bills spike another 20% to 30%, the gross margins of these AI titans will get violently squeezed. Okay, the memory and storage sector is actually holding up pretty well, since memory chips trade more purely on supply and demand dynamics. And macro oil noise doesn't easily crack their fundamentals. In fact, they might even catch a beat as an inflation-resistant tech play. And as for software stocks, the market already survived on SaaS applications this year. Their competitive modes are already showing cracks. Throw in a liquidity drain caused by $100 oil, and they're staring at an indiscriminate valuation wipeout. Don't be fooled by the S&P 500 barely dropping last night or the Nasdaq closing green. The storm is brewing just beneath the surface. Pure panic is actively spreading through the derivatives market. The one-month option skewed on the S&P 500 just spiked to its steepest level in 4 years. The premium on puts compared to calls has become insanely expensive. In plain English, everyone from mega funds to retail is aggressively buying puts to hedge. Nobody's betting on the upside. I was tracking on the EBC market buzz, and the current sentiment on the S&P 500 has flipped to extreme bearish negatively. This is incredibly rare. Goldman Sachs' deep order flow data is flashing the same warning. Institutional money managers have completely shifted their execution into crisis mode. This kind of tape pressure usually means a black swan event is right around the corner. But remember, maximum panic equals maximum opportunity. If you follow my videos and move to cash early, this macro meltdown is an absolute gift. If we backpack the 7 major geopolitical shocks since 1950, the S&P 500 typically dumps around 4% in the first week, but it almost always fully recovers within a month. Geopoliticals can shake the weak hands, but it can't kill the underlying fundamentals. This perfect storm of bearish news is just flushing the system to create room for the next massive bull run.